So, you think $500 isn't enough to even dip your toes in the stock market? What if I told you that little bit of cash is exactly how some serious wealth stories get started? Forget about Wall Street feeling super complicated. Today, we're making investing easy. You're going to learn the simple, clear steps to take that $500 and turn it into your very first real investment. We're going to pull back the curtain on the stock market together. The $500 dream versus the where do I even start problem. You've worked hard. You've managed to save up $500. And honestly, that's fantastic. Seriously. It's the perfect starting point for your investing adventure. But let us be real, the stock market can sometimes feel like an exclusive club with a secret handshake, right? You hear about stocks, ETFs, brokerage accounts, and it's enough to make your head spin and think, maybe this isn't for me, or good grief, where do I begin? Feeling overwhelmed like that is totally normal. Lots of folks think investing is way harder than it actually is, especially since there are so many tools out there now to help. But I'm going to show you, step by step, that it's not as tricky as it sounds. We're going to take that $500 and transform it into your very first real investment. Section 1, Core Tutorial, the simple steps. Step 1, what are you actually investing in? Stocks and ETFs made simple, alright. First things first, let's chat about what you're actually putting your money into. You've probably heard about stocks and ETFs, but what are they, in plain English? Imagine a big, successful company, maybe it's your go-to coffee place or that tech giant whose phone you're probably holding. When you buy a stock from that company, you're essentially buying a tiny little piece of it. Think of it like owning a single brick in a massive skyscraper. If the company does well and its value grows, the value of your piece, your stock, can go up too. That's one way you can make money. Now, picking individual stocks can be a bit like trying to find the one winning horse in a giant race. Pretty tough, especially when you're just starting out. That's where ETFs, or exchange-traded funds, come into play. And honestly, they're a beginner's best buddy. Think of an ETF as a ready-made basket of investments. Instead of you buying stock in just one company, an ETF holds shares from many different companies, as sometimes hundreds, or even thousands, all bundled up. So, when you buy a share of an ETF, you're instantly spreading your money across all those different companies. This is called diversification, and it's a really big deal. It's like instead of betting all your hopes on one racehorse, you're betting on a whole field of strong runners. If one stumbles, the others can still help carry you forward. So, why are ETFs so awesome for beginners with $500? First off, that instant diversification we just talked about. It helps lower your risk because you're not putting all your eggs into one basket. Second, they're usually really low cost. Many ETFs have tiny fees called expense ratios, which means more of your money stays working for you. Third, they're just as easy to buy and sell as individual stocks, and you do it through something called a brokerage account. For beginners, a really great place to start is often with a broad market index ETF. You might have heard of the S&P 500, that's an index that tracks 500 of the biggest U.S. companies. An S&P 500 ETF tries to match the performance of those 500 companies, giving you a nice slice of the wider U.S. stock market. There are also total stock market ETFs that are even broader. These are excellent for building a varied portfolio with a relatively small amount of cash. So, let's recap. Step 1. Stocks are tiny ownership pieces of a single company. ETFs are baskets full of many stocks, giving you instant diversification and often lower risk. For your first $500, zeroing in on a broad market ETF can be a really smart move. Step 2. Choosing your investment account. Brokerage basics. Okay, so you have an idea of what you want to invest in, or probably an ETF. Now, where do you actually go to buy it? You need an investment account, and specifically, a brokerage account. Think of a brokerage account as your personal gateway to the stock market. It's an account you open with a brokerage firm. These are companies licensed to buy and sell investments like stocks and ETFs for you. Opening one is usually pretty easy and can often be done online in about 10 minutes. There are tons of brokerage firms out there. For a beginner, here are a few key things to look for. No or low account minimums. This means you don't need a pile of cash just to open an account. Many great brokers have $0 account minimums. Commission-free trades. This is a big one. It means you don't pay a fee every time you buy or sell a stock or ETF. Most major online brokers now offer $0 commissions for online US listed stock and ETF trades. User-friendly platform, especially when you're starting out. You want a website or mobile app that's easy to get around and understand. Lots of brokers have really intuitive platforms designed for new investors. Educational resources. Some brokers offer articles, videos, and tools to help you learn more about investing, which can be super helpful. When you're checking out options, you might also come across the term robo-advisor. A robo-advisor is a service that uses computer algorithms to build and manage a diversified portfolio for you, usually with low-cost ETFs. You tell it your financial goals and how comfortable you are with risk, and it handles the rest. This can be a great hands-off approach, especially if you're a bit nervous about picking your own investments. They usually charge a small annual fee for this service. The other route is a DIY do-it-yourself brokerage account, where you pick and manage your own investments. This is what we're focusing on for buying your first ETF. Many brokers like Fidelity, Charles Schwab, Sophie Invest, and Robinhood are known for being beginner-friendly, offering things like $0 commissions and no account minimums. The sign-up process usually means giving some personal info, like your name, address, social security number, and job details. This is all standard stuff for regulations, and then linking your bank account to transfer your $500 into the brokerage account. Some brokers even offer paper trading, which lets you practice buying and selling with fake money before you use your real cash. It's a neat way to get comfortable. So, step 2 is all about finding a good home for your investments. Do a little homework. Look for low fees, ease of use, and those $0 minimums, and you'll find a brokerage that feels right for you. Step 3. Finding your first ETFs with $500. You've got your brokerage account set up, and it's funded with your $500. Awesome! Now it's time to find that first ETF. Remember how we talked about broad market ETFs, like the ones that track the S&P 500 or the total stock market? These are often fantastic starting points. On your brokerage platform, there will be a way to search for stocks and ETFs, usually by their ticker symbol. A ticker symbol is like a nickname for an investment. For example, popular S&P 500 ETFs have symbols like VU, IVV, or SPY. Total stock market ETFs might have symbols like VTI or ITOT. When you look up these ETFs, you'll see their current share price. Now, some popular ETFs might have a share price that's over $500. Don't sweat it. This is where something called fractional shares comes in super handy. Many brokers now let you buy a fraction of a share. This means if an ETF share costs, say, $400, you don't need to buy a whole share. You can tell your broker you want to invest your $500 into that ETF, and you'll own 1.25 shares. Or you could invest $100 and own 0.25 shares. Fractional shares are a total game changer for investors starting with smaller amounts because they let you invest in potentially high-priced assets and spread your money out effectively. Even with just $500, you can invest pretty much your entire $500 without worrying about leftover cash sitting around. Another thing to peek at when choosing an ETF is its expense ratio. This is the annual fee the fund charges, shown as a percentage of your investment. You want this number to be as low as possible. Many broad market index ETFs have incredibly low expense ratios, like 0.03% or 0.04%. That means for every $10,000 you have invested, you're only paying $3 or $4 a year in fees. That's fantastic. So, for instance, you could decide to put all $500 into one S&P 500 ETF or a total stock market ETF. This gives you broad diversification right off the bat. Or, if your broker offers fractional shares for multiple ETFs, you could potentially split your $500, maybe $300 into an S&P 500 ETF and $200 into an international stock ETF to get some global exposure. Ray though for your very first investment, keeping it super simple with one broad US market ETF is perfectly fine. The key for step 3 is to use your brokerage platform's tools to search for low-cost, broad market ETFs, and use fractional shares to make your $500 work hard for you. Don't get bogged down into many choices for your first one with simple, diversified ETF is a perfect start. Step 4. Making your first purchase the big moment. This is it, the moment you actually become an investor. It might feel a little nerve-wracking, but the process is usually very straightforward on modern brokerage platforms. Once you've picked your ETF, let's say it's an S&P 500 ETF, you'll head to the trading section of your brokerage account. You'll typically need to enter the ticker symbol, type in the ETF's ticker symbol EGVO. Select Buy. There will be clear buttons for buy or sell. You're buying. Choose order type. You'll likely see a few options for order type. For a beginner making a long-term investment, a market order is usually the simplest. A market order tells your broker to buy the ETF at the best available current price. There are other order types, like limit orders, where you can set a specific price, but for your first purchase, a market order is generally fine. Specify amount. Here's where fractional shares really shine. Instead of saying how many shares, many platforms will let you enter the dollar amount you want to invest. So, you can just type in $500 or whatever part of your $500 you're investing in this ETF. The platform will then figure out how many shares or fractional shares that will get you. If your platform makes you enter the number of shares and you're using fractional shares, you might still be able to enter a dollar amount, or you just calculate how many shares $500 buys, e.g. If a share is $100, you could buy 5 shares. Review and confirm. Before the order actually goes through, you'll almost always see a confirmation screen. This will show you the ETF you're buying, the estimated number of shares, the estimated cost, and any commission, which will hopefully be 0. Double check that everything looks right. Once you confirm, your order gets sent to the market. It usually happens very quickly, within seconds or minutes, especially for popular ETFs during market hours. And just like that, congratulations! You've bought your first ETF. You are officially an investor. Take a second to let that sink in. You've taken a really big, positive step. You'll be able to see your new investment in your brokerage account's portfolio section. Step 5. What's next? Playing the long game. You've made your first investment with your $500. That's a huge win. So, what comes after this? The most important thing to get your head around is that investing, especially in things like stocks and ETFs, is generally a long-term game. You're not trying to get rich quick, you're planting a tree that you want to see grow steadily over years, maybe even decades. One of the most powerful things in investing is consistency. That $500 is a brilliant start. But imagine adding to it regularly, maybe $50 a month, $100 a month, or whatever you can comfortably set aside after covering your essential bills and any high-interest debt. Many brokerage accounts let you set up automatic investments. Even small, regular contributions can make a massive difference over time, thanks to something called compounding, which is basically your money making money. This strategy of investing a set amount of money at regular intervals, no matter if the market is up or down, is called dollar cost averaging. When prices are lower, your fixed amount buys more shares, and when prices are higher, it buys fewer. Over time, this can help smooth out the average price you pay per share and reduce the risk of dumping a large sum in at the wrong time. It's a great strategy for long-term investors. Something else to think about is reinvesting dividends. Some ETFs, particularly those holding stocks that pay dividends, will pass those dividends on to their shareholders. Many brokers allow you to automatically reinvest these dividends back into buying more shares of the same ETF. This is another cool way to use the power of compounding and can really boost your returns over the long haul. And finally, keep learning. You've taken the first, most important step. Continue to educate yourself about basic investing principles. There are tons of free resources online, often directly from your broker. The more you understand, the more confident you'll become. But remember, for most people, a simple strategy of regularly investing in low-cost, diversified ETFs and holding on for the long term is incredibly effective. Don't feel like you need to constantly fiddle with things or chase the next big thing. Demystifying and encouragement seem not so terrifying, was it? Taking that $500 and turning it into a real investment is absolutely doable, and now you have the roadmap. You've just made your first investment. That's a huge step towards building your financial future, getting a bit more peace of mind, and really taking control of your money. Now, it's perfectly natural to worry about the value of your investments going down sometimes. The stock market does go up and down, that's just how it works. There will be good days and bad days, good years and not so good years. But remember, by investing in a diversified ETF, you've already spread out your risk. And by committing to a long-term approach, you give your investments time to recover from any dips and grow over time. Historically, despite the short-term wobbles, the stock market has trended upwards over the long haul. The key is not to panic when things look a bit down. Stick to your plan. That $500 is your starting line, your foundation. Every little bit you add consistently is another brick in the financial house you're building. Alright, let's quickly run through the simple steps we covered, understand what you're reinvesting in. We cleared up stocks and focused on why ETFs are great for beginners. Instant diversification and low costs. Choose your investment account. We talked about opening a beginner-friendly brokerage account with no minimums and commission-free trades. Find your first ETF. We discussed looking for broad market ETFs like S&P 500 or total stock market ETFs and using fractional shares to invest your $500 smartly. Make your first purchase. We walked through the easy process of placing a buy order. Think long-term. We stress consistency, dollar cost averaging, and reinvesting dividends for long-term growth. You now have the blueprint to turn $500 into your first investment. The most important thing you can do after watching this is to take that first step, if you feel ready. I'd love to hear from you. What are your biggest questions about getting started? Or if you've already dived in, what was your first investment? Let me know in the comments below. And if you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell for more simple investing tips for beginners. Your support really helps the channel out.